Hello students, welcome to all of you Shiksha 360 certificate course classes. Today basically we will discuss the chapter number 2, that is inward remittances part 1. This is basically chapter number 2 part 1. So here the first word, all these topics are very important for the examination point of view, and we will discuss in detail. That will help you to not only clear the examination, but it also help us for understanding a lot of concepts. So we have to discuss in detail all the points. So first thing which we have to know here, what is the meaning of the word remittance? So what is remittance? Basically a remittance is the funds an expatriate sends to his or her country of origin via wire. What is the meaning of wire, mail or online transfer? We will discuss one by one. Basically how they have to send the funds via wire, mail or online transfer. Clear? Basically remittance that is from one country to another. Here, these peer-to-peer transfer of funds across borders are economically significant for many countries that receive them. So the process of remitting foreign money, to a country is called inward remittance. Okay, it is a collective phrase used to mention the money transfer. Okay, it is a collective phrase used to mention the money transfer to a country from another countries or other countries. Technically, inward remittance is the process through which a foreign bank or company transfers the fund to the domestic bank account in the home country. Like we can say that any Indian working in any other country and they send the money to their family members. So that is, we can say that remittance. The process is initiated, like person is working in Dubai, so they can send the money from Dubai to India. So, and all the process it is going in the Dubai. So the process is initiated at the foreign nation and takes place with the consent of the customer. Non-resident Indians send money back home primarily to support their families and for business and investment purposes. However, study reveals that 65% of the total inward remittance, that is, the money we receive from the foreign countries, is for the family support. If we are getting 100 rupees, out of that 65 basically for the family support. India receives the highest amount of inward remittance in the world. A World Bank study reports that in 2010 alone, India received about $55 billion in remittances. Okay, so the data it is to be different in different years, but just for the understanding purpose, we are discussing the data, and in the examination, they will not ask the data-based question, clear, which is going to be changed. Okay. So you can also join for CAP, JAP courses or promotion exam courses. All the courses will be provided by our study center. Now, what are the different approved methods or remittances methods to India? Among the many methods available for remitting money to India, bank wire transfers and sending money through agents. Okay, among the many methods available for remitting money to India, bank wire transfers and sending money through agents like Western Union and MoneyGram are the most popular ones. Sending money through the agents, it is a very easy and fast job. However, it is a risky one too, because there are also chances of getting theft in the case of agents, or they will take commission too much high. So now we have to discuss one by one. First here, which we have to cover, that is bank wire transfer. And we will also discuss what are the different types of the wire transfer and how this process it is to be going on. So in this method, money is transferred from one bank to another. Okay, so in this method, the money is transferred from one bank to another using the electronic medium. And in this case, the transfer basically generally takes 2 working days. Takes 2 working days basically, in which case international wire transfer. Okay, the banking codes are required for the transfer of funds and also for identifying the branch in India. Okay, banking codes basically we can say that here Swift code it is to be used here in bank wire transfer. Swift code it is also used. So before moving towards the money order, I will discuss types of the wire transfer, that is domestic wire transfer and the international wire transfer. Domestic wire transfer, that takes place on the same day. And international we have already discussed, that is basically within 2 business days or 2 working days. Now little bit more discuss regarding the international wire transfer for understanding the concept. International wire transfer are initiated in one country and settle in the another. Senders must initiate. Okay. So international wire transfers are initiated in one country and settle in the another. Senders must initiate international transfers even when they send money to someone in another country who has an account at the same bank. Okay. And these payments require a routing or the Swift code, which we have already covered. What is the important point? How many days generally? These wire transfers are normally delivered within 2 business days. This extra day is required because international wires must clear a domestic automatic clearing house ACH and also its a foreign equivalent. Okay, that is conversion of currency also takes place here. So note, domestic wire transfer can cost up to $35 per transaction or more. And international wire transfers often cost much more, little bit much more. Some receiving institutions, like you are sending money to India and where in which bank basically you are sending, they are also taking some charge. Okay, so some receiving institutions also charge a fees which is deducted from the total amount received by the customer basically from the foreign country. Okay, so this is the basic discussion regarding the wire transfer and especially international wire transfer. And here the important one, that is generally it takes 2 working days. Next point, that is money order. This is quite similar to the postal money orders except that the process is done by the bank. Postal money order, the process it is to be done in the post office, and here the process it is to be done by the bank. Here, the bank allows the remitter to buy the money order. Okay, the bank allows the remitter to buy the money order outside India and send the money to beneficiaries in India. Okay, the bank allows the remitter to buy the money order outside India and send the money to beneficiaries in India. So the money order, it is sent by the bank. It uses the services of the postal department of the ship's country to finally hand over the money. Okay. Money order, that is the money sent through the basically physical currency. This is a time consuming process when compared to the other methods. Like you are sending the letter. Similarly, if the money is to be sent through the bank, that is to be considered as the money order. Otherwise, it is to be postal. Clear? And I request all of you, if you have any doubt, any query regarding any point, then you can also comment in the comment section. We will discuss that point again in detail, but very carefully you have to attempt the examination. Next one, that is foreign currency checks. With this method, foreign currency check. Now we have discussed wire transfer, money order. Now NRE basically what they will do, give the check. Check it is of the foreign bank. And how you have to be clear that check in India. So with this method, The NRI, what they have to do, just has to write a check and send it to the recipient. Since the check it is in a foreign currency, it is called foreign currency check. The recipient, we can say that, or beneficiary, can deposit it in his or her account with the bank in India and use it whenever he or she needs it. Okay. The recipient can deposit it in his or her account with a bank in India and use it whenever he or she needs it. What is the main advantage or disadvantage? The main advantage of this method is that the process is very simple. Just you have to write the check and give it to the recipient. What is the disadvantage? Like in India, the currency is rupees and the check it is to be in the currency, like we can take example like dollar. So it will take time to convert that currency, and depends upon organization to organization how the process it is to be going on. Okay, so the disadvantage is that it is a time consuming affair. The usual time taken for this method is 20 to 25 days. However, the time constraint can be reduced a little by sending the check through courier services. However, banks nowadays are using various products like cash letter plus service, etc. What is cash letter? I will also discuss. Okay. So with this type of service, that significantly reduce the time of remittance and in some cases facilitate immediate credit. Okay. So with the passage of the time and the advancement of the technology, you can send the money within minutes also. And very rarely, like these methods are to be used now, like money order. You will see very rarely this method it is to be used presently. Now next one, foreign currency draft. Earlier we have discussed foreign currency check, that is basically 20 to 25 days. Now next one, that is foreign currency draft. Now let's discuss regarding that. So sending a foreign currency draft, it is basically similar to sending an ordinary bank draft, except for the difference that the draft is sent overseas. Okay. Sending a foreign currency draft, it is similar to the ordinary bank draft, except that is now we are getting the draft from the overseas. So this payment, it is generally advisable for making payments. This method is generally advisable for making payments for business transactions or when the payment it is to be made to an unknown person. Like check, it is not necessary that check it is to be cleared. Sometimes it is to be bounced also. But draft, it is a prepayment instrument. That is, you have already paid the amount to the bank, and after that, bank release the draft. So there are no chances of bounce back of the draft. Okay. So the normal time taken for encashment of foreign currency draft, it is 21 days. Okay. So foreign currency check we have also discussed. Foreign currency draft we have also discussed. One question which they will ask in the examination regarding that. So basically it is generally used for, it is generally or advisable for making payments for the business transactions. Next one, that is you have seen on the screen, SB remit. There is one more, that is remittance card. What is that? Remittance card. A remittance card, it is a reloadable debit card. It is like a debit card which is reloadable. The NRE has to buy the card. Here you have seen that remit, sender, receiver. Okay, all these things you will see. Whatever we are discussing here, everything it is seen in the image. The NRE has to buy the card under the ship's name, under the recipient's name, that is beneficiary name. registered. Clear, the NRE has to buy the card under the recipient's name, registered, and send the remittance. Once the recipient receives the card, he can use it at ATMs and stores. The NRI can transfer the money as per requirement. And this type of services, basically it is provided by the ICICI, Axis and SB and many more other banks also. Many more banks in the pipeline to join the scheme to acquire a significant share in the liquidating remittance business. The main advantage that is cards can be easily purchased and it is very cost effective, not very much costly like in the case of wire transfer, you have to pay a hefty amount for transferring the money. Next one, direct deposit or ACH transfer. So in this method, the NRI authorizes a bank, generally an Indian bank, to withdraw funds from his foreign bank account as per his instruction. Okay. So the method or this method is recommended when the NRI has to send money home on a regular basis. And that money can be used for expenses in India. That is comes under the direct deposit or ACH, automatic clearing house transfer. Okay. So these are some of the different ways. Next one, that is there is any limit for sending money from the foreign country to India, because when you are getting money from the foreign country, there is also many illegal things are to be going on. So you have to very carefully regarding that. And here we will also learn some new words or terminologies. So inward remittance limit. The FEMA, that is Foreign Exchange Management Act, which governs all foreign exchange transactions in India, does not specify any limit. Sorry. As per this act, there is not any specific limit for sending money to India. A reason for that could be to increase the foreign exchange inflows to the country. And India is the largest beneficiary of inward remittances in the world. As there is no restriction, one can freely send any amount of money to India, either to his own accounts or to those of his relatives. It is a fact that, very, very important terminology, FIRC. You will get in the examination either the full form or what is the meaning of this terminology. Foreign inward remittance certificate. It is a fact that foreign inward remittance certificate, it is not required for any remittance, for any of the remittances to India if they involve relatives of NRI. However, okay, so in the case of NRI, they will not require the FIRC certificate, that is foreign inward remittance certificate. However, for business purposes, one needs FIRC certificate for getting the tax concession. Clear? So in the case of business purposes, it is required or it is advisable to take the FIRC certificate. Okay, so that you can, if any income tax department basically ask for the data, so you can provide them the data. Now move to the next point. What is FIRC? So a sorry, a FIRC, it is a document that serves as a proof of inward remittance. That is, you are getting money from the foreign country to India. So thus, when Indian exporters receive payment in foreign currency, the FIRC document, that is foreign inward remittance certificate document, will act as a proof of the transfer. Everything it is to be mentioned under that, for which thing they are getting the receiving the money. Okay, so it is like a receipt of proof for exporters or business that they have received a transfer from outside India. In India, getting an FIRC is crucial as it helps authorities like the custom departments and the DGFT, that is Director General of Foreign Trade, to track all the transactions. Often, foreign funds act as a vehicle for illegal activities such as money laundering. So if the authorities question for the foreign transaction or look at it suspiciously, so an FIRC certificate acts as a guard against such legal hassle. Okay. So I think you are able to understand all the points to be here regarding that. Why the FIRC certificate it has to be mandatory, not mandatory, like you consider advisable here, that is you have to take. Now next one. Okay. So these are different ways of transferring or remitting money to India. Now, one another definition, that is who is a resident. So section 2, subsection 5, 1 of Foreign Exchange Management Act 1999 defines a person as a resident in India. Clear, defines a person as a resident in India. If a so when any person it is to be described as a resident in India, if a person is residing in India for more than 182 days. A person residing in India basically for more than 182 days during the course of the preceding financial year, but it does not include, clear, during the course of the preceding financial year, but it does not include, clear, what it does not include. That is, a person has gone outside or gone out of India, or who stays outside India, in which cases for on taking up employment outside India, for carrying on a business or vocation outside India, that is for business work or for vocational courses or vocation, for any other purpose in such circumstances as would indicate that his intention to outside India, basically for an uncertain period. Clear, that is period it not to be, period is not a specified. Okay. So when any person it is to be resident of India, that is if a person is residing for more than 182 days, that is during the preceding last financial year. Next one, a person who has come or stays in India in either case, otherwise then that is for on or taking up employment of India, for on carrying of business or vocation in India, here basically outside India, here that is in India. Okay. In which case it is to be considered as a resident. Or for any other purpose in such circumstances as would indicate his intention to stay in India for an uncertain period. Now, some example, that is a person who has come to India and has taken up employment of India will be considered as a person resident as a person resident in India. A person who has gone abroad for carrying on business as there it is considered non-resident condition, that is staying in India. If the person is Indian citizen, but now gone for the foreign country, basically for the business purpose. Okay. Also, a student who goes out of India to pursue higher studies, it is also treated as a non-resident. Okay. So here you are able to understand under which category it is to be treated as a resident and under which category it is to be treated as a non-resident. Okay. So in this session, we have to discuss up to this much point. In the next session, we will discuss some other points regarding the general rules on inward remittances and some other points. Okay. And other terminologies. Hope you are able to understand all these terminologies. Regular session we will take till your examination. Okay. So you can able to understand all the terminologies and MCQ will be discussed in the respective group. So thanks to all of you for joining this discussion. And I request to all of you, please share this video with your friends also.